Everyone says Bitcoin is decentralized, but here's the plot twist. Bitcoin secretly follows the US markets more than most people think. Let me show you the connection that traders miss. Over the last few years, Bitcoin has shown a strong correlation with the US stock market, especially the Nasdaq 100, which tracks tech giants like Apple, Microsoft, and Nvidia. Why? Because global investors treat Bitcoin the same way they treat tech stocks, a high-growth, high-risk asset. When Nasdaq pumps, Bitcoin usually pumps. When Nasdaq bleeds, Bitcoin feels the pain. In fact, in 2020 to 2022, the BTC-Nasdaq correlation hit 0.8. That's almost a mirror move. So what connects a decentralized digital asset to the US stock market? It all comes down to liquidity and risk appetite. Whenever the Federal Reserve prints more money, cuts interest rates, or signals dovish policy, Wall Street gets extra liquidity, tech stocks jump, and Bitcoin jumps with them. But when the Fed tightens policy or raises rates, risky assets crash, Nasdaq drops, Bitcoin gets dragged down too. Here's something interesting. Bitcoin's biggest bull runs happened right after major U.S. liquidity boosts. 2013 rally, Fed's QE, 3 money printing, 2017 rally, dovish Fed, low rates, 2020 to 2021 rally, biggest money expansion in U.S. history. So yes, Bitcoin is global, but the heartbeat of Bitcoin still beats in sync with U.S. monetary policy. But here's the twist. Ever since Bitcoin ETFs launched, the correlation with Nasdaq has started dropping. Why? Because now institutional investors treat Bitcoin as a separate asset class, similar to digital gold. This means Bitcoin is slowly becoming less dependent on tech markets and more dependent on macro cycles, liquidity flows, and ETF demand. So next time you see the Nasdaq pump or dump, remember why it's not just tech stocks reacting. Bitcoin is connected to the same macro engine. If you want more macro crypto breakdowns like this, hit subscribe, and I'll simplify the next big story for you.